I'm super excited to bring you one of the very famous venture capitalists who has been creating maximum value for emerging fund managers and through his direct investments. He has been a founder and managing partner of Plexo Capital, but previously he has also worked as a partner at Google Ventures and Comcast Ventures, and he's also a very prolific angel investor. Welcome to SheVC. I'm your founder and host, Gayatri Sarkar. So today is that amazing day. We have Lo Toney with us. He is the founder and managing partner of Plexo Capital. So super excited to welcome you, Lo, here.
Thanks so much for having me. I'm a fan.
Yes, and I have been trying to get Lo for such a long time, and it has been incredible that I have got such amazing feedback from other people in the industry, and they wanted to hear what Lo's take on venture capital. So my very first question to Lo is that you have been a prolific investor, a partner in amazing funds like Comcast Ventures, Global Ventures. So why you think there's a need to create a platform to invest in emerging fund managers, and how did you receive any setback when you pitched to the LPs?
So this strategy got started when I was a partner at Google Ventures, or GV, as it's now rebranded, and it was purely about alpha. So the ability to be able to identify other sources of differentiated deal flow. And what we decided to do was, in looking at the landscape, we saw that there were many more women and people of color in the micro VC space than in the large multi-stage, multi-billions in AUM firms. And it really became clear after having a few conversations. I mean, I knew this without having any conversations, but the path for a Black VC in particular, I'm Black, so I could relate to that, was really not the traditional path. But as a result of that path, there ends up being a great network in place for Black VCs, as well as a different lens to both evaluate opportunities that might get missed on Sand Hill Road, and also a different lens to evaluate entrepreneurs. So at GV, we decided to make 5 LP investments into seed stage firms led by a woman or a person of color. Started with 5 Black GPs, and I expanded it to women and people of color. And it worked for us. We got differentiated deal flow at an earlier stage based on the insights and the networks of the people. And I thought that there was an opportunity to scale that up into a standalone platform. And Google is an amazing place because, my boss, the CEO of GV at the time, David Crane, he said, well, if we have 20% time, this would probably be a good opportunity to use it, kind of thinking about the classic thing at Google where you can spend 20% of your time doing different activities. Didn't really have that at GV, but decided that this was worthwhile to do it. So I came up with the strategy. We started doing it in 2015 at GV, and I came up with the strategy in February of 2016. Spent 6 months or so with my product manager hat on, kind of thinking through how I should structure Plexo Capital, and then decided that it was viable. I just looked at the number of firms that were in the market that were led by a woman or a person of color. And around Thanksgiving, I decided to go after it full time. So in essence, I transitioned into being an entrepreneur in residence, but instead of working on a company, I worked on Plexo Capital as my company. And then I spun it out in March of 2018 and brought on Alphabet, the holding company of Google and GV, as our anchor investor, brought along the 5 original LP investments into the Black GPs. And then, and those Black GPs included Cross Culture Ventures, now rebranded as Mac Ventures, Next Play Capital, Precursor Ventures, Base Ventures, and Ulu Ventures. And then subsequent to Alphabet giving us the anchor investment, we raised from Intel Capital, Cisco Investments, Kapor Capital, the Royal Bank of Canada, Hampton University, and HBCU, where I went to school, and the Ford Foundation. So that, so the genesis was really to identify an alpha strategy to get access to deal flow that other people weren't seeing, differentiated, and then to really, think the way that I like to think about it with Plexo Capital is we've got all of these great GPs in the market looking at tens of thousands of companies. And what they end up doing is curating that down to their portfolio. And so we're working with the GPs, seeing which companies are doing well and might be able to benefit from the value add that we can provide, and then look to invest in those companies directly. And I really think of Plexo Capital as a strategy to have outstanding returns, but an important byproduct is
Hmm.
the fact that I believe that we're kickstarting these vertical ecosystems, like around Black entrepreneurs, people of color, and women. So if we can get capital from the top of the stack to the Black GPs or female or people of color, we know that the data says those GPs have more diverse portfolios. So they're going to have portfolios of founders that are going to be Black, female, and other people of color. And then they're going to hire in turn, right? They're going to hire Black, female, and people of color. And so then if there's an exit, a liquidity event, then all of a sudden you have these employees who can become angels. So they can write checks to other people in their network. Maybe they can even write checks to some of their former coworkers who, since now they have a financial cushion, will feel more comfortable taking that risk of becoming an entrepreneur. Many people, Black or people of color, don't want to take that risk
Yeah.
because they don't have the financial backstop. But if there's a liquidity event, then all of a sudden there's the ability to take that risk. And then for the founders themselves, they start to head down a path of wealth creation. Hopefully they can be sent down to a generation or two. Capital is returned back to the GPs. So now the GPs are able to start down their path of wealth generation. And then capital is returned back to the LPs at the top of the stack. And the LPs look at that and say, oh, this is amazing. Let's double down and do it again. So, I think of a byproduct of our work being able to provide good positive signal early in the fundraising cycle for a fund one or a fund two that's going to institutional LPs this time. And if we can be that positive signal and kind of help to accelerate the access to capital in the fundraise process, I mean, that's a big benefit. And it ultimately is going to benefit entrepreneurs as well. So I see this as being very similar to a regional ecosystem when it's developed. You have a good pool of talent in a lot of these regions that might come out of a big company like think Seattle and Microsoft and Amazon. Those people that are employees, they are able to amass a little bit of wealth. They become angel investors. Some of their coworkers go and start companies and then raise from them. Some of the people start venture funds. And so, you have a whole ecosystem develop. And I see something similar that's a byproduct of what we're doing on a kind of a vertical basis.
That's amazing. I love what you said about the wealth creation. And I think you kind of answered my question that I wanted to ask you, is that, the systemic changes that needs to be brought in, because, there's so much of opportunities that are lying there and we are leaving a lot of money on the table. So before I go on to, on that side of the question, I would love to know, like, what are the qualities and track records you're looking for, not only just emerging fund managers or the companies that you're investing, and especially tell us about your YC of GP Accelerator platform.
Sure. The ability to be able to identify outstanding GPs that are going to build the next generation franchises. I mean, that really is first and foremost what's most important for us at Plexo Capital. I think we lean a lot on the LP side of the equation. And when we like to meet as many GPs as possible. So we like to understand who's in the market. The one thing that we really focus on is we're disciples of the power law distribution of returns in early stage. And so when one looks, so the data source that we've looked at, which looked at about 20 years of returns to about like pre-seed, seed, series A, it shows that, there's a median return of 5.6%.
Yeah.
And there's the mean, which gets pulled out, which creates the power law shape of 22%, which these are on an annualized basis, right? And
Yeah.
so first, let's talk about the 5.6%. one would never incur this level of risk for a 5.6% annualized returns. There's easier, less risky ways to be able to get that return. What everyone is looking for are the outliers that pulls that mean away that generate the 22% return. And we know that if we're able to cast as wide a net as possible through our GP's underlying portfolios, then we have a really good chance of getting as many of those as possible that are going to be the outliers, the unicorns. So it's really important for us to have a few things happen. Number one, we know that portfolio construction is the magical tool, and we like to see a portfolio construction that aligns with the thesis of the GP. You know, and it can be, you know, a number of portfolio companies, 40, or it could be concentrated as well. It really just, for us, we like to make sure that the portfolio construction kind of matches to the GP strategy. We have done concentrated portfolios. We tend to do those with vertically focused or sector focused GPs. So we've got a couple of enterprise focused GPs, and they tend to have smaller portfolios. We think that actually makes sense. We think it makes more sense for a generalist to have a larger portfolio.
Yeah.
And then we like to look for GPs that actually are leading deals. That's super important for us for a few reasons. Number one, we like the fact that it takes a lot of conviction to be able to lead a deal. There's going to probably be an additional amount of diligence that's being done. Maybe the GP is actually even operating or investing off of a thesis that they have around a particular opportunity in the market or an inefficiency. And so we just know that there's a little more thought that happens when that thought leadership is shown. And then a secondary effect of having GPs that lead is that it naturally minimizes the overlap of the portfolios, right? So if we have a group of GPs that were just investing as a syndicate and not leading, then we likely see we see great logos, but we'd see a lot of overlap. So we'd miss that opportunity to, again, cast as wide a net as possible. So I think what ends up happening is, even though we like to talk to a lot of GPs, there are a lot of GPs that don't meet that criteria around portfolio construction. And so that's a critical piece. The other thing that we look for, and I think this was part of your question, is track record. And whereas a lot of institutional LPs will have such strict criteria, it actually eliminates the ability to get to a lot of women and people of color. We're a little bit more flexible on that piece. So, you know, we will invest in a solo GP. We'll invest into a fund one. In fact, we like fund ones. And that's fine. And as far as track record, we're obviously, if it's a fund two, and then we have the fund one track record to look at, that's great. If it's a fund one and the GP comes out of another shop where they allow attribution, that's awesome, because, you know, we can take a look. And even, you know, there are even ways kind of around that. If they don't really do attribution, you can kind of get to understand a GP and talk to the entrepreneurs, talk to other GPs, and you kind of know, you know, who actually sourced a deal, who worked on a deal, who took the board seat or an observer seat. And then the last piece that we'll look at in the absence of those others we'll actually look at a GP that has assembled a track record based on a prolific history of angel investing, or even putting together SPVs to be able to invest. Because, you know, and I guess another element would be, if a GP has worked for an entrepreneur as an advisor at a few companies and received advisor shares, we'll actually even kind of think about that, because time is finite. And so there was a decision to be made about whether or not to actually advise this company versus, you know, company A versus company B. So we try to be as flexible as possible, because we know, again, you know, there are a lot of things that just kind of eliminate women and people of color. No solo GPs, no fund ones. You know, you have to have a verifiable track record of at least 7 to 8 years. So we try to be as flexible as possible. But to be honest, like the portfolio construction and the track record, those are actually really quick checks.
Yeah.
The thing that we really start to drill down on is the sourcing network. And then once we get to the point where we feel good, we start to look at the value add network, like what does the GP's network look like after they've written a check? And then at the very end of the process, which is perhaps the most important for us, is references. So really referencing deep on entrepreneurs that the GP has worked with, as well as other GPs, right? And so we take all of those things together because, the portfolio construction could be right, and then the judgment could be right. But if there's not a robust pipeline of deal flow to apply that judgment to, then, it kind of doesn't matter. And then we like to understand the value add, because what that lets us understand is the differentiation of the GP. And that's something that I think is really overlooked. This is where I say, think like a PM when trying to present your story to a prospective LP, or even more importantly, to a prospective entrepreneur to take your money. What is it about the GP that allows them to win deals? What's the superpower the GP has that makes an entrepreneur want to have their money as opposed to someone else's money? Because a lot of people have money right now.
Yeah.
And then, understanding, what's the reputation of the GP, and, do the entrepreneurs talk about the GP and reference that superpower without being prompted? So that's kind of, those are all the things that we look for. And the reality is, there are a lot of great GPs that we meet that just don't map to what we need to do with regard to our philosophy on power law and, leading the deals and all the other elements. So, I like it when Plexo Capital is positive signal, right? So when we come in early and other LPs look and we're positive signal. But what I try to remind people is that, hey, don't think of us as negative signal if we're not in a deal. I mean, we have seen great GPs and have referred them to other LPs where they might actually be a better fit.
Absolutely. And I like how you talked about women and emerging fund managers. And we are seeing a lot of micro funds around pre-seed funds. And now these micro funds have become like an institutional asset class. So do you see a change in the market with this COVID-19? And do you see some new market opportunities coming up for emerging fund managers?
I think what we were already seeing, we were seeing a little bit of a renaissance in venture capital anyway, I feel. I just think that there are a lot of, fund ones, or, some operator GPs that, are kind of maybe still doing some work. Maybe they're a founder CEO, but they're also doing a little investing, and they've kind of formalized that by taking some outside money. So I almost feel like we were already seeing a renaissance in venture capital. I mean, I could even make the argument that, our model is different, and, I think it's different for a reason. So I feel really bullish about what we're seeing in the marketplace in terms of innovation. It's always amazed me that here we are, and, you think about the nexus of all of these different intellectual minds coming together to create the future, and the people that are financing them have been just kind of not trying to change the model. And so the model has to be changed. I mean, that's kind of just, you got to innovate. And so I'm hopeful that we'll see more innovative models. And, I think it's okay in the case of some of these funds that want to continue to stay small. But I really hope that we also see some innovative models that can achieve scale as well, and actually get to, multi-billions in assets under management. That'd be pretty exciting to see.
No, that's great. I love what you said. Like, the LPs, they're so used to their certain kind of models, and they love that. They don't want to change it. And, in Fortune, June 2020, there was an article talking about investment management is overwhelmingly dominated by white men, and women are only 8% of professional investors. And they're very, very like small handful of people of color who are GPs, and far less Black women who are GPs. So, I know you talked about this a little bit, but I would love to know, like, what systemic changes are required to bring more capital deployment to women and diverse GPs, especially from the LP side?
Well, I think we're starting to see it. I think the reckoning of what's happened with the unfortunate killing of George Floyd has been a big, a big propellant, like some tailwinds we're starting to see. I've seen some great initiatives that have come out from places that I wouldn't have expected. I've seen outreach from, you know, prospective LPs from places that I would never have expected, just interested in our model and what we're doing. So I'm bullish, but it's going to take a lot more work. And to your point, it has to start at the top of the capital stack, in my opinion. The LPs are really where that has to, you know, it has to stem from the LPs, because the LPs provide the GPs with the funding. And, you know, when you start to think about the different types of LPs, you've got the high net worths, you got small family offices, you've got bigger family offices that behave like institutionals. Then you've got the true institutional, the pension funds, the endowments, the healthcare organizations, the foundations, the fund of funds. And so we're starting to see some more interest, but we've got a long way to go, unfortunately. And, you know, kind of back to that, you know, that notion of the LPs funding the GPs, funding the entrepreneurs. If we can get capital into the hands of diverse GPs, they're going to make sure that they're, just by virtue of their networks and the things that they're seeing, they're going to get capital into the hands of diverse founders. And so you need that flywheel to start, though. So you need to actually have the realizations to be able to provide liquidity and get that capital back to the GPs, who get it back to the LPs, so the LPs can actually see that it's working. But you got to like pay it forward to a degree, and just have an understanding that the opportunity is there. There's no shortage of great talent. There's no shortage of Black entrepreneurs, female entrepreneurs, other people of color that are entrepreneurs around the globe, right? And so I think, you know, that's the thing that needs to happen, is kind of that recognition of, hey, we've gotten trapped in this world of pattern matching, and, you know, things have got to change. I think, you know, I would like to see not only more firms led by women and people of color, right? But also I want to see more women and people of color inside of the multi-stage, multi-billion and AUM firms. And what I really think is important is the ability for those people that are female, Black GPs at big firms, or people of color, have the ability to have the environment welcome their perspective, welcome their network. What we don't want to see is, you know, a Black GP goes to a big firm and then all of a sudden is concerned about tapping their network to bring in opportunities, because they don't want to be perceived as the diversity person, or they don't want to have one deal that no one likes, and then they feel like, oh, I can never bring another, you know, person of color in. So, you know, I'm concerned about that, and I want to make sure that we don't see that. So I mean, there has to be a lot of change. I feel like we're at a point where there's a window that's been cracked open, and my hope is, or I say I'm pragmatically optimistic, that we'll be able to get as much of this through while that window is open as possible.
Yeah, I totally agree. I think Plexo Capital is definitely giving such strong signal, when you are looking at the emerging funds and you're looking at investments, and especially in early stage equity investments. So if LPs has to look and ask you like how your risk profile adjustment have changed, and how you being a model investor and how you have tackled this when people are still struggling with the diversity problem.
Yeah, and you know, the interesting thing is we just believed that the demographic trends were shifting. And when we started to look at all of the rising investors and all the talent, it was just super clear that the future franchises are just going to be diverse. And so we felt that it was a good place for us to start. And the criteria that we underwrite to is similar to what I would underwrite to if I were not looking at women and people of color, right? So we want to underwrite to a minimum of a 3x net return from GPs. And actually, ideally, what we're really looking for is, you know, 4 or 5 or 6x, especially with the smaller funds. And the way that we think about our portfolio construction within Plexo Capital is we modeled out for Fund 1 21 LP commitments, and we're sitting at 20. I don't know if we're going to make it 21st, but we're sitting at 20. And the goal was to be able to separate those between some of the larger funds, call it, between 15 million to about 100 million or a little bit over 100, and then sub 15 million. And so for the ones that are 15 to 100, on average, we've done a $2 million commitment. And for those under 15, we do a flat 500K commitment. And so the thought is for the smaller funds that are, we've invested in quite a few proof of concept funds. And the goal is to be able to get in some instances, we're the only institutional investor, and that's okay. But we see something in that GP that indicates to us that they are going to start a franchise. And so we want to get in and start to build that relationship early. Because what we've also seen to be the case, and this is playing out, we have one GP that's going through this right now, you start to see success, but then if the GP decides to keep it slow, and then all the institutions start knocking down the door, the GP is going to turn to whoever was able to make that bet on them first. So we want to make sure that we can build that relationship, because in our world, this is like a, 2 or 3 fund commitment in essence.
Yes.
And it's really important to be able to identify those great funds. And, look, the thing that I really like about our model is that we're trying to have as high a floor as possible while having the upside, right? So that the funds and the power law distribution model, if we pick the right funds, if we cast that net really wide, right? Like it's you're diversifying across multiple funds, so you're naturally going to lower the risk there. But if we're doing this model correctly, we should still have a pretty high floor on what we think the bottom is for our returns, and then having additional upside from doing the direct investments as well is kind of how we've modeled this. Moving forward, we hired a financial engineer, and so we're working on planning for what the future would look like and looking to add other elements. We're very interested and have been looking at the secondaries market for a year. We're very interested in investing in the management companies of GPs. So we think that there's other ways that we can modify the model as well to kind of keep the same kind of risk profile, but have even more upside.
That's great. And I think this brings me to my next question. I definitely want to understand and ask you, like a lot of seed investments nowadays, they are trying to be a full stack VC fund. They're trying to invest in the entire life cycle of an early stage company. So how do you look at the time diversification? What's your perspective when it comes to time diversification in private venture investing?
Yeah, we probably are seeing some interesting things happening right now, like in, for those funds where the vintage includes both pre-COVID and post-COVID opportunities. We're big on time diversity. I think the challenge is, for a young fund, especially if they're going to go through a 24-month fundraising process, how to kind of manage that first close, and then how much capital should be called and then deployed when there may be a little bit of uncertainty on the future closes. And I think what you don't want to see is, you don't want to see a situation where a fund has called a significant portion of call it 50% of the capital from the first close LPs before even finishing up the actual fundraise itself.
Yeah.
So that's a little risky, because then there's too much concentration in the investments that were done in that first period. So now you think about a COVID environment, right? And so, even though we haven't seen a lot of the changes that we thought, who knows, I don't think we're still out of the woods on COVID yet. But, imagine for a moment a scenario where a significant number of investments were made in a certain vintage year, but then some black swan event happens. And so then now, after that black swan event, the dynamics of those deals have significantly changed in terms of valuation, capital that was raised, timeline between capital raises, and the terms itself. So what you don't want is, okay, now you have a big part of your investments from that fund vintage in this pre-black swan event, and everyone's going to look at your fund relative to these other funds that maybe they closed or deployed most of their capital post that black swan event. So I think, time diversity in and of itself is just really important, just because you never really know what's going to happen within the market. Plus, innovation doesn't really know what the stock market is doing. Innovation doesn't know what the economy is doing. Innovation is going to happen throughout all types of economic cycles. And so I think what we probably had seen for the past few years was, a shorter timeline, a truncated period between funds. And my hope is that we'll go to, I think LPs are actually even pushing their GPs to have a little bit more time between funds, which naturally kind of lends itself to having time diversity built in when there's a longer time between funds. And I think that's a good thing.
Yeah, I definitely think that's a good thing. So since we're talking fund management 101, I would love to know your take. There's always this question about, the returns on investments versus the multiples on the fund returns. And
Mhm.
how do you navigate those questions with your LPs?
Yeah, well, so with our LPs
With our
specifically.
LPs, or do you think like how will the fund managers navigate such questions? Because sometimes people are hybrid models, or people have different kind of model of investments, and they have some of great returns, and then their fund multiples are different. So I would love to know your take on that.
Yeah, I always think about the discipline within the portfolio construction to be able to identify what needs to be underwritten to deliver a particular return. So that's the most important piece. And, I think at the end of the day in our world, I think every investment needs to be thought of as having the potential to return the fund. Now, that said, there's flexibility. So if it's a smaller fund, then you don't necessarily need, the multi-billion dollar outcomes. You could probably do it with a few $500 million outcomes as well. But nonetheless, one needs to always think about, okay, if I'm going to underwrite this deal, I need to be very disciplined to think about what the potential is for the return here, given my size of fund and my portfolio construction model. So I think that's the most important thing. And then within the overall context, at least for us, the way that we think about the world is we want to see the TVPI, the total value to paid in. We like that because it's a net multiple, right? So, it's easier to do an apples to apples comparison amongst
Yeah.
GPs when we're looking at TVPI as opposed to the MOIC, the multiple
Mm.
on invested capital, because that doesn't take into account
Yeah.
that one GP might have a 2% management fee, another GP might have a 2.5% management fee and lower fees. So the TVPI to us is the important multiple. And then we also like to obviously see, as the moolah and the kula, as Chris from Ahoy always says. So the DPI, the distributions to paid in. I mean, that's important because one could have, amazing, markups, but at the end of the day, markups don't pay the bills. Cash pays the bills. And then, I think the IRR is also, something we look at, although, the IRR can be a funky metric, especially early on, and it can do some funky things. So I think longer term, once you get past maybe that 5-year mark or so, IRR becomes important. But that's the way that we think about the world. I do like to see, from an LP perspective, I do want to see the TVPI and the DPI, but I also want to peel back the onion a little bit and have the GP explain to me, what's actually driving those returns, how concentrated are those winners that are producing the good looking TVPI numbers. So that's important as well. But I never really, dig into the weeds too much on an individual basis. I just want to make sure that there's consistency. I want to make sure that there's not too much concentrated risk within one position, because then you might start to ask, well, are you thinking about liquidating a portion of that position? So those are some questions to ask. But I think it's also nice to see a nice distribution of the markups
Yeah.
and the DPI. And look, we all know that there's going to be, one or two companies that are really going to drive the fund.
Yeah.
But early on, it's just kind of good to get a barometer on kind of how the investments are performing and what's really driving the TVPI in particular.
That's great. And since we are on that topic and we are talking about, the realized gains, let's talk about, recycling the realized gains versus, distributing that gain to the LPs. What's your thought on that?
Yeah, and I know you had Brad Feld on, and I think he has, that's the piece that I read. Whenever we decide to recycle, I always, in my management letter, I reference Brad's blog post where he talked about that. Look, we're big fans of recycling. We like the ability for a GP to put as close to the amount of fund raised to work as possible. And the way to do that is to recycle. So especially if there are returns early on or realized gains early on, put it back to work. I think your LPs would probably say, well, hey, I really wasn't expecting a distribution this early anyway. So you might as well put it back to work and then have the ability to be able to kind of get to, the math becomes a lot easier to kind of get to that benchmark 3x net return when more capital is put to work.
No, that's great. And coming back to all these questions, and I think you had been, one of the lightning rods in the venture capital industry. So many of us look up to you and look up to your values. And the way you're answering the question, I think this will be like a case study. It's almost like venture capital 101, fund management that we are going through. And, I'm a GP at a sports fund and a big fan of Brian Gumbel. And recently, Brian Gumbel was at HBO Sports in his favorite, show. He was talking about black tax, and I asked the same question to Arlen Hamilton also. And I would love to know your take, especially you being the position where you are, as a fund manager, as a black fund manager, and someone who's putting capital deployment, space, understanding the mindset and the wealth creation. Have you personally ever paid black tax?
Yeah, I think it's hard to be a black man or woman. I'm a man, so I'll give that perspective. I think it's hard to be a black man in America and not have that, right? I think whether it's, I had to go get I had to get new tires on my car, and I hadn't driven the car in a long time, and I hadn't even put the registration sticker on there, and so I forgot to put the registration sticker on. I drove my car over, and then I was like, oh my God, I'm glad I didn't get pulled over because I didn't have so I put my sticker on immediately. But those are the thoughts that go through my mind, and then on the way back, there was a cop behind me, and I was like, there we go. Now I'm glad that I put my sticker on there because otherwise I would have been pulled over. And so I just think these are just the things that happen both in one's personal life or whether it be one's professional life. I mean, look, I've been the only black person in a room so many times. I mean, you kind of start to get used to it, right? But nonetheless, I just wonder I wonder if this situation would have happened if I were white, or is it only happening because I'm black? I mean, at the end of the day, I can't really think about that all the time because that's all I would do. Right. So I kind of just have to go and just live my life. I've got to like hop in my car and I've got to be mindful and understand that, there are certain situations that I don't want to place myself into and what to do if I find myself in those situations. And I do the same thing with my kids to try and teach them, or in the business world. I just have to kind of go on and go about my business and know that I'm doing things that I feel are done with integrity, are done with thoughtfulness, are done with research, are done with a good decision-making process. And I just try to be the best that I can be, but I do always fall back to something that my uncle told me. He was an admiral in the Navy. And he said, look, when the reality is, you're going to have to work twice as hard to get half as far, and it's going to take twice as long. And I sometimes I look at myself in my career, and I can hear him saying those words to me, and I can see how that plays out. But I'm blessed. I mean, I think that I'm very fortunate to be in the position that I am. I've had some amazing mentors. I try to give back, but we just have a long way to go. I'm hopeful. Or as I like to say, I'm pragmatically optimistic about where we are right now, because I haven't seen things like this. I've asked my mom, who saw things in the 60s when she was young, and she said she's never seen it like this. So we're hopeful right now.
That's great. I think we're all hopeful. And I love what you said about society's pattern matching. And venture capital is also about, identifying patterns and being thoughtful about those steps, that if you take those steps, what are the, implications. So I would love to know, like, my last question to you, and I know you have to go. So
I've got another podcast in 4 minutes.
Exactly. So I would like to ask you, the last question is, like, what are the learning habits that you have acquired, and how do you maintain your work-life balance? Because, venture capital is not a career, it's a lifestyle. So how do you maintain that lifestyle?
Yeah, that's a good one. That's a good question for my 19-year-old son who's interning for the second year. And, we have a team now, and his questions are always, I don't know. He's like, Dad, I don't know how you did all this by yourself. I don't have a great work-life balance. It's even tougher right now with the gyms being closed, because that was my outlet, was going to the gym. But, I try to make time for friends. I try to make time for family, for sure. But I don't make a lot of other time. Like, people always ask me, hey, what books do you read? I'm like, I don't read books. Maybe if it's a business book, I'll read it, but I don't read books. Maybe I'll get a little bit of dumb TV in when I'm doing email. But now there's, what the Wall Street, Michael Douglas, the character that he plays, said, money never sleeps. And so that's kind of the adage that I live by.
Thank you very much, Lo. Thanks a lot for your time, and we're super excited to have you.
Thanks for having me.